to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, everyone, welcome back to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, the high man, AJ Brown.
Hey, I've got suns out, and now the guns are out.
You know, I picked the background before you picked the shirt, and you must just be feeling summer, feeling holiday, feeling vacation.
I can't wait. I'm heading to Cali for a couple of weeks coming up, so I'm kind of stoked.
Yeah, and I think the plan is we're going to try and do a live show live in person, so we'll see how that goes next week. So stay tuned.
Stay tuned.
Otherwise, it's August 12th. Feel like there's a lot still going on in the markets, even though we're in the middle or the beginning or in the dead of summer. A big driver for this week specifically was the subtle CPI numbers. So AJ, did you take a look at that? Did you get any feedback? What are your thoughts?
Yeah, I just threw them up on the screen. So, the big number that everybody was looking at was right here, month over month. So month over month, we had no growth in inflation. That doesn't mean that inflation we've turned into a recession. It just means that it's not increasing. That's good news. Year over year, it's still pretty high, but the fact that month over month it's at zero means that what the Fed's doing might indeed be working. I also think we pointed to something a couple of weeks back, that China was selling a lot of its bonds. I think that's helping as well. So they're helping us inadvertently. And I almost think that what they're doing is trying to make a political statement, but in effect, it's helping us help with our inflation. But I think that people on our group, on this phone call, even though the mainstream media puts a lot of emphasis on this number, I think we want to factor out and we want to look at what the Fed's doing, right? We want to actually look at what the market movers are looking at. So even though the mainstream media gets us all excited about CPI being at zero, let's factor out food and energy because those tend to be the most volatile, and look at those numbers. And those numbers were quite impressive as well, right? They were expecting 0.5% growth and they only got 0.3% growth. And a lot of that has to do with services. So I think that this was a positive move. We'll get one more of these reports before the Fed meets again at the end of September. So if we get a trend going, I think Wall Street can be happy.
Right. And so a trend, would you contend like we want the numbers to start to go the opposite direction or just not go up as much?
I think if we can continue to see month over month either being at consensus or even a little bit lower like it was this time around, I think that's going to show that the measures that the Fed is doing have had effect and that the Fed can relax a little bit.
Yeah, it's interesting to see how quickly data is coming in from their actions, right? Like I feel like the market or the economy never evolves so quickly from those actions.
I know. That's the scary part.
And so one of the things that I was thinking when you mentioned the CPI is it was followed by the PPI. So what is the big difference between the PPI and the PPI?
I mean, put it kind of like in a very third grade kind of explanation. CPI is the inflation or consumer price index that we're seeing on the retail side. PPI is what you're seeing on the wholesale side. And so what that means is you can kind of, if there's a big difference between CPI and PPI, it means that those end kind of distributors of whatever the product or service are, they're taking profits, right? So we always look at, and this one, this producer's price index, it's usually explained a day after or reported on a day after than the consumer price index. And it doesn't get as much media exposure. And I'm kind of bummed by that because it's actually probably more important than the CPI, at least in my view. And so month over month, you can actually see that wholesale inflation shrunk by 0.5%, wasn't just flat. And you can see year over year. Now you can see that the year over year was hotter than CPI. So what that kind of tells us is that in order to not lose sales, the distributors have been kind of letting, they've been taking profits out of their pockets to keep prices a little bit lower for us end users because their supply side prices have been much higher. And that's what we see here. And so now that both the PPI and the CPI are coming down, they're now taking that moment to get a little bit of extra profits. That's kind of what we're seeing in there. But again, that's not bad. They're both coming down. This is great news because that means that the Fed can kind of slow down on their very aggressive policies, and Wall Street would like to not have the camera on it like it does right now. One last thing is always look when you're looking at the actual economic reports, look at these ones where they factor out X food and energy, or they factor out X food and energy and trade services, because that gives you an idea of the actual inflation out there. Because when you put in food and gas prices, they're so volatile by all sorts of world events, conflicts, who sneezed, who killed what reporter, who, all of that, stuff. It makes the numbers kind of off kilter. So always take a look at these kind of numbers here when you're looking for absolute values.
Yeah, and so the improvements have been pushing the market higher. You did mention that some of the bond selling was playing a factor. You said this was China, but also the U.S. side. And we've been talking about this one for weeks.
Yeah. Remember, everybody, that when the Fed is so the Fed had purchased, let me go back a little bit. So if I take a look at the overall Fed balance sheet, we've been talking about this for weeks. They started accumulating bonds, right? They started buying treasury bonds, corporate bonds, and mortgage-backed security bonds. And so what are they going to do with it, and where did they get the money to buy those bonds? Well, they're the only investor out there trading who can actually, when they want to buy something, just create money to do that. And so what they've been doing, as you can see in this overall graph since 2008, they've been injecting money into the markets, right? They've been injecting money into the markets. That's what the Fed does, right? They figure out ways to put money in or out of the markets, keep it either flowing or slow it down. And then if you're thinking about on the fiscal side, that's called monetary policy. On the fiscal policy, like what's going to be passing probably today in the U.S. government, is they figure out how to distribute all that money, because when the Fed pumps it in, the Fed only has a few different outlets to put the money into the market. So it's up to the government to figure out how to distribute it. Otherwise, it winds up in only a few places. So when they buy bonds, it's whoever's been selling the bonds that gets the money, right? And so that means like big money investors. So if you want to figure out a way to get money to the little guy, the government has to step in and take the money from the big investors and distribute it. Okay, now you take a look at just the last couple of months. This is the last 3 months. In fact, if I take a look at the last 6 months, you can see what happened. The Fed had advertised that they were going to start selling their bonds, and they're doing a pretty good job. It looks like it's choppy, but in reality, from the peak of having close to $9 trillion of bonds that they just magically created money to create, they're now down, at least as of last Thursday, down to 8.87 trillion. So they're slowly knocking it down. And I looked at the report from yesterday. So this is the report from yesterday evening. They actually went down even more. They're now, instead of 8.87 trillion, they're down at 8.84 trillion. So they sold off another $30 billion worth of bonds. Now, when they sell their bonds, what do they do with the cash that they make? Well, they have to shred it, right? They created the cash. So when they sell it, they shred it. And what that does is it makes the remaining bond yields go up. So we know that for like the last 5+ years or even more, if you put your money into a bank account, you're not going to make any money. And so people have been looking for different investments that will actually make their money work for them. So they've been getting more aggressive, like money that was in bank accounts got moved to mutual funds. Money that was in mutual funds got moved to stocks. Money that was in stocks got moved to options and Forex and commodities. Money that was there got moved into things like SPACs and REITs and crypto and all of that stuff. And some stock companies that otherwise wouldn't have been popular got funded. Like the ones that come to my mind are like Peloton, or even some private companies. There's a company that I've been looking at called Calm. They have an app where you once a day log in and you get your meditation on, right? And these companies in a regular environment probably would not have gotten much investor interest. I mean, look at Peloton. Peloton is a company that has a very kind of niche focus, and it made sense during the pandemic when everybody was stuck at home. They could buy a Peloton. And so Peloton shot up, and they thought that those were sustainable gains. But when you start to bring reality into the situation, as soon as the pandemic's done and people want to go to the park, they don't want to sit in their living room and sit on a fucking mechanical bike. So, you know, the question mark is, was Peloton really a worthwhile company? Same with this Calm. I mean, we were all kind of going crazy, stir crazy, cabin fever, sitting at home. So meditation apps were popular. Now we can go out and have drinks with our friends at the local pub, right? And that's kind of a funner way to have meditation. And so I saw that Calm let go of 20% of their employees. Peloton stock has dropped. And that's just also an effect on the investor side. So bringing it full circle in my little talk here, full circle, when you can now start to make money in bonds again, start to make money in your savings account again, all that money for those riskier stocks, riskier investments is going to start coming back towards these new investments. And so those companies are going to be hung out to dry. And so their money is drying up. And that's what we're seeing. And the Fed has said, you know, we're not going to be on the side of the speculator this time around. So that means that the Fed is okay with some of these riskier bubbles starting to shrink or even, you know, go away.
The evolution of the markets. Another name that comes to mind in your list is Clubhouse. I was a big Clubhouser during the pandemic, and they had a huge valuation, and I actually enjoyed it. But you're right. Like, now that I can go to the pub, I would choose the pub over the app.
Yeah. And that actually makes you wonder, you're gonna, you know, like Facebook changed its name to Meta because they're focusing heavily on the metaverse. And you almost question, they're going to have to make the technology so good that you can trick the human sense, right? Because even having like an app like Clubhouse where you do get to interact with people, you miss the touch, the feeling people's bad breath on you and shit like that. So it's going to be interesting the next 10 to 15 years. But in the meantime, the Fed said that they're going to reduce their balance sheet down to 4.5 trillion. You know, right now they're at 8.84 trillion. So they've got basically another 4.3 trillion to sell off. And that's really going to move that target. A lot of these speculative companies, I mean, anything that position themselves as a disruptor. You know, Peloton said they were going to be a disruptor. It brings me back to the thought process of two companies, one that was very successful at being a disruptor and one that wasn't. And that is, Apple was the successful company, right? They're constantly disrupting with whether it be the iPod and then the iPhone. I mean, that changed the way they live life. And then the other extreme was a company that really positioned themselves as a disruptor and then fell flat because they turned out just to be a niche product. That's GoPro, right? GoPro, everybody bought them at one point about maybe 5 to 10 years ago. It was very, oh, everybody's got to have a GoPro. And then it turns out it's just for people who ride mountain bikes. So
Or
GoPro,
jump out of planes.
yeah, or jump out of planes. But you look at GoPro stock, and that totally shows that they missed the point. And if you look at GoPro stock and what it did a few years ago, and you look at Peloton stock and what it's doing right now, you realize Peloton thought they were something that they're not. They're just a niche product, right?
Yeah, so we'll definitely keep an eye on that. One quick question that I have is, last week we talked about the VIX, how the VIX has been falling because uncertainty has been, becoming lighter. So I'm just curious, with the CPI data, did that trend continue?
It absolutely did. In fact, for the first time since, back in March, the VIX is now playing with that average line, which tells me that, at least for us premium sellers, we're going back to normal premiums. A lot of the symbols don't have that. The option chain doesn't have that increased cost because people are worried about their investments anymore. It looks like that the VIX is calming down. That doesn't mean premiums go away. It just means we go back to a more typical way of doing our trading strategies. With the VIX, we should definitely take a look at the S&P 500 too, because we were wondering if we were going to find a top. And just like I had hinted at last week, if I bring back my confirming indicator, we had yet another tease of forming a top and getting it confirmed. So this was the first tease. This is the second tease. We thought that perhaps this might have been a top, but I said, watch out for the teases. And sure enough, we popped a little bit higher, mostly on that CPI. Now, this could be a little bit worrying because this is a very aggressive, we call it a range expansion move. It's expanding into the bullish territory here. And sometimes these moves need a little bit of a break. And so when it goes this far, it's almost like you run out of gas. And so we'd like to see this actually pull back a little bit in maybe the next couple of weeks in order for us to then have a renewed sense of bullishness in September. So I'm almost calling for a little bit of a pullback, maybe to around the 4,000 area, and that would be okay for those folks who are buying into this uptrend. And so I'd worry if we continue too much higher. Another thing to look at, SIP, is the more traditional indicators that people use. Let me pull them up right here. Studies. A lot of folks, and I'm talking about just mainstream investors, they like to look at the 50 and the 200-day simple moving average. So you can see here, I've just drawn, this is the 200-day. It's still trending down. This is the 200-day. And then what I've got over here is our 50-day. That's this guy. I should have had them labeled ahead of time. This is actually, this is our 50-day. This is, I like to also look, for our purposes here at Trading Trainer, we look at the 30-day. And we also, for some of our option strategies, we look at the 7-day. So here's the 7-day up here. So notice some of the crossings that we've done. So the 7-day early on crossed above its 30 and then crossed above the 50, and it's on its way up. And then the 30 kicks in a little bit later. The 30's on its way up. And now the 50 has definitely stopped downtrending and it looks like it's going to be ever so slowly starting to trend up. When we get a 50 that crosses over the 200, that's called a golden cross. And if I zoom back a little bit in time, you can see these golden and death crosses. The death cross is when the 50 drops down below the 200 day. So if I come on back here, you can see with our 200 day right here, this was March 14th was the beginning of our death cross right here. March 14th. And as soon as there's a death cross where the 50-day simple moving average dips down below the 200, everybody and their brother, everybody's grandmother, everybody's grandfather, kids, pets, they all start selling stocks. And so it just adds kind of insult to injury. But when we see it reverse like this, and we see that golden cross, you can expect people to start piling back in. All of a sudden at the water coolers, at the corporations, everybody's going to say, have you been buying stock? Have you been buying stock? So it looks like we're seeing the underpinnings of that. Anything, of course, can happen in the next couple of months, but it looks like we did indeed find ourselves a bottom a couple months back.
Yeah, and that's kind of the forecast. So while looking at the charts, AJ's got some strategies. And so what we're going to do in this next part of the show is we're going to go over one, AJ's pick of the week. And then what we're going to do is just go over a couple of user questions from the week, follow up from a couple of stocks that we talked about last week. And we're going to give people a little look at something that we've been cooking up on our end. But before we do that, let's go ahead and take a little break. If you're interested in learning more about AJ, his strategies, trading trainer, we've got a daily workshop that I'm going to go ahead and add the link into the chat. We're going to play our little commercial, and we'll be back to go over some specific names and, different ways to play them. So stay tuned.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right. That's going to be us next week, cruising around these Cal streets.
Yeah. And you know what, Sip, workshop, I update that workshop. It's a pre-recorded workshop. I update that workshop with new examples every month, and I'll be doing that this weekend. So if you guys have watched that workshop but want to get some new, fresh ideas, you might want to check it in probably around Sunday or Monday of this week. Just go watch it again. You'll get all new examples, and it might give you some trade ideas.
Yeah. And if you want a little bit more hands-on, we just rolled out AJ's awesome coaching program where he's going to walk you through strategies. He's going to get you trained up because, AJ, you've been doing this for a long time, and now you're opening up the doors, and you're going to be, letting all the secrets out, and we're giving people an exclusive opportunity. So I'm going to throw the link to the one-on-one coaching into the chat as well. And if anybody's interested in learning more, sign up there. Someone will reach out to you and answer all your questions and see if it's a good fit.
Yeah, absolutely. Put that link in there. This is a really cool thing. And we've got Joseph, or one of my other interviewers, who will call you as soon as you tell them what time and date to give them a call. So take advantage of that. Even if, it's a no obligation call. So even if all you want to do is talk about where you are with your investing right now and where you want to be, Joseph's a great sounding board. Don't feel obligated to do anything, but give him a listen and just have somebody to talk to. And that's what we wanted to put out there, especially at this time when we may be having some amazing opportunities in the markets going forward.
Yeah. So let's dig into those opportunities, because that's what we're all about here. And the first one is going to be be AJ's pick of the week, and this is an oil play. One interesting stat that I saw locally here was for 2 straight months, the price of gas has gone down every single day, and it's helping consumer sentiment. But this play on that.
Mm-hmm. Well, okay, so there's kind of a couple things going on. So I like to look near term for whatever I can grab in the near term, but I also like playing long term plays. And yes, the national price per gallon of gasoline has just dipped, I believe, down below $4. So it's coming down. And this is despite all the stuff still happening, the conflict still happening in the Ukraine. So this is great. So that brings back kind of the long-term prospects of oil, doesn't it? And the writing seems to be on the wall. If you look at some of the major oil companies, and Occidental Petroleum is one of them, they're doing very little investment in their future. They're not investing in new refineries. They're not really pushing hard on drilling, even though, they've opened up all this federal land here in the United States for more drilling. They're not really taking advantage of that. If you look closely, they're not pushing any of the pipelines that have been, talked about and have been put on hold. They're not really pushing to get them off hold. And it kind of, and just based on what's happened in the last year and a half, and you look at the amount of dollars of investment and the amount of government regulations that have been moved or softened in order to get technological advances in alternative energy. And I'm not just talking about solar, and I'm not just talking about wind. I'm talking about hydrogen, geothermal, and there's been a huge push towards nuclear. Right. And so I think the writing's on the wall, and I think that the petroleum companies know that. And one of the other things that's been interesting is when a company gets some profits, which we know petroleum companies in the last 6 months have gotten quite a lot of profits, they have choices of what they can do. They can, start building out their infrastructure and try to scale and make more of their product. They can hire more people. They can buy equipment. Or if they want to appease their investors, one of the easiest ways to make their company seem more valuable is to remove the dilution of the shares. So if they're a public company, they could do stock buybacks, right? If they buy back their stock, then the remaining stock that's out there for their investors all of a sudden becomes more valuable. If you take something that's worth $1 million and you divide it up 1,000 ways, well, then each little share, 1,000th of that company is worth $1,000. If the company buys back half of that, now the share is worth $2,000. So buybacks are a way that a company can appease investors. Well, with this fiscal legislation that's coming out, this was actually something I've been watching carefully. A lot of people gave Kristen Sinema a lot of heck for removing out of the bill one of these loopholes. But she actually emphasized putting one in, and that was to tax companies or give them a charge, if you will, for doing buybacks. So that's going to hit the petroleum companies right in the where. Right? Because when they do their buybacks to appease their investors, they're going to be taxed on that pretty heavily. They can't just go out on the market and do that. There's going to be a charge. It's going to become expensive to do buybacks. It's kind of emphasizing that companies here in the States should put their money towards expanding their business and growing rather than just appeasing their investors. All to say, I'm quite excited about shorting over the long duration petroleum stocks. Occidental Petroleum is one of them. So now I've talked about the long-term picture, which is like 5 to 10 years. If I have in my portfolio a short position, which means I'm expecting this company to start to do poorly over the next years, and I'm going to make money on them actually going down in their stock price. That's what I mean by shorting them. That's my long-term goal for my long-term portfolio, is to short petroleum companies. And Occidental Petroleum, if we look back here, I'm going to go back. So you can see that they've sort of peaked. This is a 1-year chart. Now I'm going to go to a 2-year chart, and I'm going to start to keep going back further. Let's go to a 5-year chart. And you can see that Occidental Petroleum definitely has its ups and downs. It had some big ups back here in 2018, but it had that sell-off as of about 2020. It had this little gain because people are, whatever the conflict, and people are traveling this summer. But I'm all about shorting this company. So what happens if I do short them, and it actually is giving us a signal right now? Let me put on my study that gives me my timing signals, which is the fast MACD. I'm looking for a crossing of the fast MACD, but I expect to get it either this evening or on Monday. That's going to be a signal for me to go ahead and short Occidental Petroleum. There's 2 ways to short it. I could either short the stock itself. I'll need a margin account to do that. Or if I don't have a margin account, or I even want to get a little bit of discount, I can use a little bit of leverage. I'll buy some put options. And I'll go far out. I can always roll them out if I want, but I'll go far out, probably to 2024 with these put options. And so as the stock goes down over the next couple of years, my put options will appreciate. And then if there's any point where Occidental Petroleum stops going down in the stock price and starts to go up, I can sell put premium and buy some call protection and turn it into an income trade. So in the long term, I'm expecting it to go down, and I'll profit on it going down. But every time it has a little bit of a gain, I'll just simply flip the equation, and options let me do that. So I want everybody to look out for an opportunity here where we see the fast MACD cross down below, the fast MACD average number. And that's an opportunity to do some shorting on Occidental Petroleum, which I'll probably be doing. And then if there's any sort of pauses in that reduction in price, I'll be thinking about selling some premium and making some short-term incomes. And that's my plan on Occidental Petroleum.
All right. So the play on Occidental, go ahead and throw that onto the watch list.
Mm-hmm.
The alternative to the petroleum plays are the electric plays. And so our next ticker is going to be Lucid Group. And this is Sparky from Phoenix, Arizona, ticker symbol LCID. Do we have a play here?
Absolutely. This is a premium play. I like the price. So the price is in that under $20 range. That means a lot of us can jump in on it. Yeah, this is one of the potential competitors against Tesla. I don't know much about the company. I do know that they're opening a huge factory in all places in Saudi Arabia to make these cars. But other than that, the chart is telling me, and it's funny. First of all, the headquarters is based around Phoenix, so I wonder if our person who sent in this one, Sparky, if that's really his name. But that's cute that he's interested in electric cars. So let's take a look. We seem to have a level of support around $17.50, around $18. We have a level of resistance around $21. One of the things that I like to do to see if this might be a good candidate for selling premium against is I actually like to do a simple little back of the napkin calculation. I think I've shown it before on this show, but I'm going to show it again for any of you kind of technical folks out there. So let's first make sure we are clear where we think support and resistance might be. So we were talking about 1750, and we were talking about maybe $21. 1750 and $21. There you go. And I'll zoom in so that we can really see what we're looking at here. All right. So with my calculator, what I do is I take the width of this channel. So $21 divided by $17.50, or not divided by, but subtracting 17.5. That means that this channel is $3.50 in its width, right? And I'm going to divide that number by the average channel price. Now you can calculate the average. You just take 17.5 and 21, add them together, divide by 2. But if you use a retracement ruler like I do, the same thing as the average channel price is this 50% number, which is right here in the middle, 1925. So it kind of calculates it for you, makes it easy. So if I take 3.5 and I divide by 19.25, I get a percentage. This is 18%. If this number is above 10%, I'm happy. If it's below 10%, I get the heebie-jeebies. And if it's below 5%, I'm not going to touch this symbol with a 10-foot pole, at least not with the brain of selling premium. I'd probably be interested in more of trading it as a breakout. So when you're thinking about setting up one of these premium selling trades, do this little math trick. So take the width of the channel, and I'll write it down here, the width of the channel, and divide it by the average channel price. And you'll get this percentage. And so long as that percentage is greater than 10%, you're on the right track. Okay. And so I like that about this particular stock. I wanted to do this kind of math in front of you because I wanted you to see that this is a good one to be thinking about. And we're about, in fact, today we're developing a signal to buy some of this stock. We can either buy this stock, or if we take a look at the option chain, there is some liquidity on the options that expire in 2023 and 2024. So instead of buying the stock, you could buy a call option on this. And that's a great position to be in. You'll have a call option for the long term. You know, if Lucid goes up in price, that call option will go up in price. Or if you buy the stock itself, that'll go up in price. And then, just like we were talking about on Occidental Petroleum, if it ever pauses and decides to take a break from going up, that's when you sell your call premium and buy your protection. And that right in itself, selling the premium and buying the protection, becomes a premium trade. It makes income for you for that month. And so, yeah, I think this is a great one, Sparky. I think that you should consider looking at this signal that's forming and seeing if you want to buy some of Lucid, or buy some of the call options. If you buy Lucid, buy it in lots of 100 shares, because whenever you're doing option trades, it has to be lots of 100. So buy 100 or 200 or 300 shares, whatever your risk appetite's for, and then let it appreciate. And if it stops appreciating, sell premium, buy protection, and just keep going on with that cycle. It's a great trade. Great
That's
trade.
a standard premium selling opportunity there. I'm looking back at the earnings. They just had earnings on the 3rd, and it looks like we had a strong pop off those earnings, and we're now back at the levels prior to earnings. So I think that does help with the setup here. So
Absolutely.
definitely good pickup here. Another name that comes up a lot when we talk about these electric cars is going to be our second ticker, and that is Rivian, ticker symbol RIVN. And this is Marie from Irvine, California. And they were in the news yesterday or before. I think they just released earnings.
Yeah, it looks like earnings came out. If I put my cursor over this.
Yep.
Yeah.
Yesterday.
After market close. Earnings conference call, August 11th. Yeah. So they did. I think they also beat earnings. Let's take a look at a bigger picture on Rivian. It's a little bit different than Lucid. Not much different when I look at 2 years, 1 year. So it looks like they had a lot of excitement. That excitement waned, and now it's just slowly. This happens with new companies, by the way. There's always a lot of excitement right in the beginning, and then reality sets in, and then you find out whether they're going to be viable or not, and then the slow grow for a company comes. So the mistake that a lot of investors make is they believe that the initial excitement and endorphin rush is going to last. And just, even if you compare it, it's just human nature. Even if you compare it to some of your best like relationships with friends or romantic partners, it's always very exciting right in the beginning, and then it either slows down and then you start to build a real relationship out of that, or it slows down and you break up and you find the next one. So just compare it. We're all human, and that's what the market represents, is human nature when you get down to the psychology of it. All right, I had to go on that little.
So are we breaking up, or are we getting back in bed with Rivian here?
Well, it looks like people are starting to see that there is value in the company. So what I would do here, we don't really like, the last buy signal we got was here on July 28th. So it was about 2 weeks ago, maybe even 3 weeks ago, that we got a nice solid buy signal. It kind of it comes down to your question, Marie, whether or not you feel you've got a long-term play here. If you feel like you've got a long-term play on Rivian, then waiting for a buy signal, you could probably just buy it now. It does seem to be at a kind of a greater bottom. I personally would allow for it to pull back again like it did 2 or 3 weeks ago. So let it pull back. And that would be my buy signal. So I'd wait for a pullback. In fact, what you could also consider doing, since it's not that expensive of a stock, what you could do is what we call a cash secured put trade, or other people call it a naked put trade, or selling puts. If you sell some puts, say for instance, we say $35 would be a great price to buy this stock. It's currently trading at about $39.36. I could go and I could sell the near-term $35 put, fully knowing that I need to have $35 in cash per share in order to buy this thing. So the near-term put on, let's come back here to Rivian. August 19th is the next expiration date. So if I look at the $35 put, I could make 25 cents per share if I did this trade right now. So I'd make 25 cents per share. Don't forget, we do this in lots of 100. So for every contract of options, I'd make 25 bucks. And if Rivian dips down to $35 and we get exercised, then I'll spend $35 on the stock. I get to keep the $25. I get to spend $35 per share. So if I'm willing to buy the stock at $35, and if it never goes down to $35, then I just collect $25 per contract every month I do this. Let's take a look at the September. If I wanted to not sell the August, but instead sell the September $35 put, I could make $150 off of every contract that I sell. Just knowing that if Rivian dips below $35, you need to have the $35 in cash per share. But so it's kind of a neat strategy to pick up stock, because you pick up the stock at the price you want to pay. And if you don't pick up the stock because the price doesn't come down to the price you want to pay, you get paid, right? You get paid $150 per contract, or $25 per contract if we go for the August. So it's kind of a neat strategy. That's probably what I would do. I would try to accumulate some of this stock at a discount price, a pullback, and then I'd let that stock rise. And every time that the stock falters, we go into our traditional premium selling play, turn it into a monthly income. And I think this might be a good long-term play for you, Marie. It depends on how you feel about it as well.
Yeah, and that's the beauty of options. I think at one point you said there's 27 different ways to get into a position, and so that is just a few of the different approaches to getting into a position or a company that you feel confident in. All right, moving on to our last name. This is a follow-up to last week's conversation, and that's the meme names, right? So like when you were talking about the flow of cash going into, let's call it some of these exotic companies, AMC was in that boom, and looking at the chart now, it looks like we're booming again.
Yeah, and I think last week, this was Tim, I think, if I remember correctly.
That's
He was
right.
he was up in Idaho. So what I got from Tim was Tim wanted to know what to do now. So we talked about having a buy point last week. I think that there was an opportunity, depending on, again, what you were thinking, that we would either look for a buy point or a sell point. So if you bought, Tim, okay, this is one of those things where we've talked about it before, but AMC over the last trading days has really skyrocketed in price. And so when we're talking about selling premium, we usually put in some sort of profit threshold, which means if the stock falters before we get to that profit threshold, great, we do the premium trade. If the stock continues up past that profit threshold, then what we do is we put a trailing stop in place and we take the profits and run. So a trailing stop, if you guys aren't familiar, is a stop that's usually a few percentage points lower than the current going price of the underlying symbol, but it only ratchets in one direction. So anytime the underlying symbol goes against it, the stop freezes. And so it basically keeps gaining with the stock price, and then the minute the stock price pulls back, that's when the trade gets closed. And so I would put into place, if you went long some AMC and you got some accumulated profits, I think that it's accumulated so quickly that now's the time probably to put in a trailing stop and take your profits and run. Don't worry about the premium selling. Don't worry about the protective options. Just take all your money and run as soon as that trailing stop goes. On the other hand, AMC seems like it's on fire, and it doesn't seem like that fire might be justified, right? Because even though they've been investing in themselves with all that money that came from the focus from some of those small investors that got publicized over the Reddit network and things like that, the price of the AMC per share maybe isn't justified by what they're doing as a business, which tells me that it probably is overhyped. So what do I want to do there? I want to get ready. I don't have a signal at this moment, but I want to get ready, Tim, for shorting this thing. So again, either shorting the stock, requiring a margin account, or buying some put options. And I don't have to go that far out in time. I could probably go 2 or 3 months out in time with those shorted options. And I would just buy some put options when this thing gives me a signal to start selling. Buy some put options and just let that thing drop and let my put options appreciate. But actually, if you bought some AMC or bought some call options, you could do both of these strategies, couldn't you? You could let those call options or that stock go up in price with a trailing stop. You can, take the profit there. And then when it starts to top out, buy some puts and ride it on the way back down. That's kind of a common strategy that we do with breaking out stocks, which I would say AMC is showing that sort of thing. So make money on the top side and then get ready to make money on the bottom side when it goes back down.
Yeah, and last week we talked about Robinhood, and it's funny because they're now being called in front of a congressional committee to talk about their involvement in all of these meme stocks, right? When they would freeze the orders and things like that. So that should be very interesting to see how that pans out.
Yeah, there's so much skepticism around government committees, and especially if you look at it with the eye of different demographic age groups. And so I think that young folks, like teenagers and in their 20s, have the least amount of confidence in government. And they're the ones who are the big users of Robinhood. So usually when you think, oh crap, my company is going in front of a congressional committee, that's going to be a negative. I almost feel like in the case of Robinhood, that gets it even more press. And the folks that use Robinhood are like, great. I think that gives them actually credibility instead of takes it away. So we're going to have to watch. But looking at the chart, I mean, Robinhood continues to it's finding some level of resistance, it looks like, at about $11. But if it pops above $11, you may consider this a long play. If it decides to come down from $11, this is a premium play. And so the beautiful part about options, as you just kind of hinted at, they profit in like 27 different ways. They don't just profit on if the stock goes up or down, but they can profit if the stock goes sideways. They can profit if time is just going by, if the clock is just ticking. And then one of the things that's not understood very well at all about options is that you can profit on them if there's an increase of fear or if there's an increase in confidence in the market. The option price is susceptible, especially depending on which option you choose, is susceptible to that fear and confidence. And you can play that game, and you can really take an underlying symbol that's doing nothing, just going sideways, and profit on it anyway, just because you know about how options work. And that's why people come to Trading Trainer, right?
That's right. And once again, the link to learn the 27 different ways to trade options is in the chat. Head on over, jump into that workshop, get some answers. And once again, if you're looking for a little bit more extra touch, a little extra hand holding, we've got the one-on-one coaching sessions as well, with the links in the chat there as well. Next week, AJ will be broadcasting from California, from my territory. Right. So we're going to be trying to set that up. So stay tuned for that. In addition, throughout the week, if anyone has a name that they want us to go over, feel free to drop it in the chat, leave a message. We'll see if we can bring it up on the show. If you're enjoying the content, show some love, hit that like, hit that follow, hit that subscribe button. Head on over to your local Target, grab yourself a lovely shirt like AJ's got there, and let's get festive this weekend.
That's right. It's going to be a good weekend.
All right, AJ, thank you for your time today. Thank you, everybody, for tuning in. We appreciate it. It's Friday. Let's get these positions on. Let's get out of our positions and let's go enjoy some summer while we've got it all around the country. Appreciate everyone for tuning in. We'll catch you guys next week.
Bye, everybody.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.